Hello and welcome to the Business Standard Morning Show. I'm Binu Sandhu. Let's take a look at the stories for the day. The global slowdown, it seems, is now casting a shadow on engineering colleges in India. After years of aggressive hiring, major IT firms are now giving a miss to campuses. Those hired are also in a limbo with companies delaying taking them on board. New Wipro recruits were recently taken aback when the IT major asked them to settle for a package of 3.5 lakh rupees instead of nearly double that amount, rupees 6.5 lakh, which was offered to them initially. So, is the IT dream of Indian youth turning sour? Tushar Verma's report brings the answer.
Wipro's new recruits have a tough call to make. Accept a revised annual package of 3.5 lakh rupees and join swiftly, or hold on to the original offer of 6.5 lakh and face an uncertainty around onboarding timeline. Fresh recruits across India's tech majors are facing similar situations, as companies like Infosys and Wipro are yet to complete the onboarding process for students placed from the batch of 2022. Both the IT majors have also been in the news recently for firing hundreds of freshers after they failed the internal assessment tests. And most IT majors are yet to knock at the doors of India's premier engineering institutes with placement offers. Placement processes are usually completed before the new academic session can begin in August. Salaries for entry-level graduates too have remained stagnant in the range of rupees 3 to 4 lakh per annum for the past two hiring seasons. This is despite the high inflation rates. Does this mean the IT dream, which once promised comfortable lifestyles and increased buying power, has turned sour for the Indian youth? And how will the career trajectories of new IT graduates be impacted by these recent trends?
For the last 1 year, before the last 3 months, you had attrition 20, 24, 25%. People are leaving in droughts because somebody is offering them much higher salaries. So where is the loyalty? Now the market has become very quiet and suddenly companies find the business is not coming at the pace. So they got a bit too many people, they can't manage it. And they are trying to delay onboarding of freshers for some time. Deferment of 2 or 3 months for freshers is okay. But once you make a salary offer, don't cut it down and say, you take half and come join earlier.
India's IT majors have added less than 5,000 new employees in the fourth quarter of FY23. TCS even reported a reduction in headcount by more than 2,000. Through the pandemic years, IT majors had stepped up their hiring in hopes of an increased demand. They now seem to have eased off the gas in their hiring commitments. Does this rapid backtracking on hiring policies point towards a deeper governance issue?
The IT sector is no longer a recruiter of choice in the leading campuses of India. From a governance perspective, yes, ESG, the social aspect of it, is impacting how these IT sector companies are perceived by freshers and by employees, right? So to that extent, I think they would need to pull up their socks from a demand planning perspective, from their recruitment practices perspective, from their compensation benchmarking vis-a-vis other large companies perspective.
The employment scenario in the IT sector of India has definitely taken a hit. IT majors are facing governance and planning issues. Some experts say that in a free market economy, both people and organizations are free to join and leave for better opportunities. Nevertheless, they do agree that the big four of the Indian IT sector do need to re-evaluate the recruitment planning.
The Russian attack on Ukraine, which plunged the world into economic slowdown, completes 1 year today. The United Nations has said that the 8,000 civilian deaths recorded in Ukraine is just the tip of the iceberg. The war-ravaged country continues to count its dead with no sign of truce. The world is also paying a heavy price with several major economies staring at recession. India too isn't unaffected. In this report, Bhaswar Kumar explains how the war has affected India's economy and foreign policy.
आज का युग युद्ध का है नहीं और हमने फोन पर भी कई बार आपसे इस विषय में बात की है कि डेमोक्रेसी और डिप्लोमेसी और डायलॉग ये सारी बातें ऐसी हैं कि जो दुनिया को एक स्पर्श करती हैं। फूड सिक्योरिटी की, फ्यूल सिक्योरिटी की, फर्टिलाइजर की, ऐसी जो समस्याएं हैं हमें जरूर कुछ रास्ते निकालने होंगे।
Prime Minister Narendra Modi's remarks reflect how the challenges faced by India since the start of the Russia-Ukraine war on February 24th straddle both the economic and foreign policy domains. The war, which has now entered its second year, came just as India was coming out of the COVID-19 pandemic. It led to an increase in crude oil prices, drove up food prices globally, and led to supply bottlenecks. The result? Significant inflationary pressure. In India, this made the Centre and the Reserve Bank of India's task of striking a balance between growth and inflation all the more challenging. The RBI also had to keep up with the rise in global interest rates that followed. India's import bill for both fertilizers and energy also jumped as a result of the conflict. And the centre's budgetary math came under pressure as its subsidy outlay ballooned. For FY23, the centre had budgeted fertilizer subsidy at 1.05 trillion rupees, but the revised estimate showed it bulged to 2.25 trillion rupees as the centre pumped in extra funds to shield farmers from the conflict-led spike in fertilizer prices. In FY24, however, both the food and fertilizer subsidy bills are slated to drop sharply. So how do experts sum up the economic impact? And how do they see things developing in the future?
The entire energy market and the food grain market, particularly the market for wheat globally, has become badly disrupted, which essentially meant that a large number of countries who were sourcing energy and or wheat from Ukraine and Russia had to look for alternative sources, which in the case of energy meant essentially a complete rejigging of supply routes, with our traditional suppliers shifting to providing to Western Europe and we having to move to Russian. As far as the wheat market is concerned, what it did was it sent the global wheat prices through the ceiling, which had its knock-on repercussions on our grain prices. So if you look at the recent inflation story, it has essentially been driven by food grains. So the impact is indirect, but nevertheless quite significant.
It looks like that nobody knows when this war will end. This also means that the global economy will have to get used to this kind of a situation. And I think most countries have already made their adjustments in terms of consumption of different commodities, especially of oil, of gas, that is, I'm talking of the Western economies. So as far as India is concerned, with global commodity prices having cooled off, crude oil coming back to the levels of around $80 to $90 per barrel, we do not really fear that there will be any further escalation in prices of crude oil, which could be affecting also products like fertilizers. And that's probably one of the reasons why the budget has assumed that the fertilizer subsidy bill can actually be lowered in the year, because there will be certain gains to be made with low crude oil prices prevailing for most part of this financial year. So there won't be any surprises as such to us on account of the war, which means that the fiscal math can progress in a normal manner.
India's energy mix also saw change. Indian refiners rarely bought Russian oil before the war due to costly logistics. But they are now snapping up discounted Russian crude amid a slew of Western sanctions on it. And Russia has displaced India's traditional oil suppliers and now accounts for a little over a fourth of its total oil imports, ahead of Iraq and Saudi Arabia. India's purchase of Russian oil has been guided by energy security needs, but this decision has come in for criticism in the West. Balancing India's long-standing ties to Russia as supplier of strategic defense equipment with its deepening relations with the West, a key source of investment and new age technology, has been one of Indian foreign policy's key challenges since February.
The Indian foreign policy establishment, the Honorable Prime Minister, the Foreign Minister, and others who led this challenge have, in my opinion, navigated this particularly well and to the benefit of the people of India. Whether it has meant in terms of what we have articulated at the G20, helping to bring together a declaration on the subject and resolving matters in a manner which gave peace a chance, which said war is not the way of doing things today. Whether we've been able to negotiate our purchases of petroleum products, absolutely essential for our people and a better life for our people. How we've been able to tell the world that, look, instead of simply finger pointing, let us try and give diplomacy a chance. Certainly, Western European and other countries of that ilk, they turned around and said, either you're with us or not with us. But look, we have been able to tell people we are a large economy, a large society, and we have to stand up for our interests. Our interests are not against yours, but our interests are about ourselves. And sometimes there are collateral issues which fall out as a result of, what actions you have taken, mostly unilaterally. They have understood.
India has by and large adjusted to the war's fallout and emerged as a bright spot in a global economy beset by headwinds. But escalation cannot be ruled out entirely, meaning safety from further disruptions and uncertainty isn't guaranteed. A new Russian offensive has reportedly begun, and Russian President Vladimir Putin has suspended Moscow's participation in the last remaining nuclear arms control pact with the US. The war has entered its second year. The world may not be able to afford a third.
India's aviation sector, meanwhile, is on the cusp of a change, with airlines planning to induct a record number of aircraft. Air India recently placed an order of 470 aircraft. Indigo is poised to take deliveries of around 500 planes, and Go First and Akasa Air have orders for up to 72 aircraft. Analysts believe that these increased capacities will support the world's third largest and the fastest growing aviation market in the world. But are these triggers enough to give wings to related shares? Or are there risks that the markets are not factoring in? Nikita Vishisht does a sector check in our next report.
The Indian aviation sector is soaring, and how? From about 169 million passengers in financial year 2013-14, India's total air passenger count touched an impressive 345 million in FY19. At present, air traffic is nearly 97% of pre-COVID levels. Analysts say a host of factors is fueling Indians' appetite for air travel, keeping the growth outlook intact on a long-term basis.
The recent deals in the Indian aviation sector is a very big positive in creating an international hub in India, which is the third largest aviation market and the fastest growing aviation market in the world. There are multiple factors which makes the Indian aviation story a very good from a long-term perspective, including rising passenger traffic, which is close to pre-COVID levels, rising income and the middle class, which will boost both the international as well as domestic traffic, the rich demographic dividend of India, and also the government's focus to improve the regional connectivity under its Udan scheme.
Industry experts peg passenger traffic growth at 25 to 30% over the next 3 years as airlines build capacities to support demand. Air India recently placed an order of 470 aircraft, which is the highest ever in the aviation industry globally. Moreover, industry body CAPA expects other domestic airlines led by Indigo to place orders of 1,000 to 1,200 aircraft in the coming 2 years. That said, the next 6 to 12 months may be turbulent for the stocks as a possible rise in crude oil prices and increased competition may negatively surprise the markets.
So perennially, one major issue is the oil price. Okay. So the oil price, once in 2-3 years, it comes and hits this industry by spiking. Now, for example, because of China opening up the economy, and secondly, OPEC this week has predicted that oil demand, global demand will go up, quite significantly from the middle of this year. So, once in a while, the oil spike will hit them. There is no doubt about it. So, which is quite possible in the second half of this calendar year, because from mid of this 23, many economies are expected to improve their GDP growth. That is one. So, this is a structural problem, and therefore, the linear profit growth is unlikely to happen for the industry as a whole. Real mighty competition. Now, Indigo is going to face very severe competition, because Tata Group backing is there, and they are also, thinking, planning to merge Vistara with Air India. So, this is another structural change which would be negative for all small players. They would find it difficult to survive, and also negative for Indigo because it would find it difficult to consolidate and retain the current the market share, which is above 50%.
From investment viewpoint, Chokkalingam suggests long-term investors could buy Indigo shares after 10 to 15% correction. Brokerage firm JM Financial too said Indigo will likely benefit from sharper demand comeback and relatively weaker crude environment. However, its ability to maintain market share and run glitch-free superior operations in the face of stiff competition from the Tata Group will be the key determinant for a sustainable rally beyond crude cyclicality. Overall, analysts remain cautious on the sector's near-term prospects as elevated ATF prices coupled with increased competition will continue to pose a major threat to earnings and the liquidity profile of the airlines in the near to medium term. Over the long term, an established limited players market with revenue share stability will support the outlook. As regards today, global cues and stock-specific action will guide investors.
Indian companies with a larger greenhouse gas footprint will soon have to pay a new tax on their products in several developed countries. It is called the Carbon Border Tax. India recently wrote to the World Trade Organization to register its objections, calling it discriminatory and protectionist. Now, what is the Carbon Border Tax? We decode it for you.
A carbon border tax is a duty on a product that has to be paid against the carbon emission that the production involved. It is also known as EU Carbon Border Adjustment Mechanism or CBAM. The European Union has agreed to impose this tax on imported goods such as iron, steel, cement, electricity, hydrogen, aluminium and fertilizers. The purpose of the carbon border tax is to discourage carbon emission. This tax will come into force from the 1st of October 2023. In the first phase, which will be of 3 years, only carbon emission reporting regulations would apply and there will be no need to pay the carbon tax. After the transition period, tax would be levied on varied goods in a phased manner from 2026 to 2034. Under this regime, importers will have to purchase carbon import certificates or permits for each metric ton of CO2 brought into the EU through goods they are bringing in. The price of certificates will depend on the carbon intensity of these goods. Most of the EU member countries already have carbon emission taxes. They impose high costs on carbon-intensive businesses in their own countries. But companies can sidestep this by moving production to a nation which doesn't have this tax. This practice is called carbon leakage. According to the EU's Carbon Border Adjustment Mechanism, the tax on the imported products should be paid by the importer in the European Union. Alternatively, the non-EU exporter can present a certificate of the tax paid for the carbon emitted during the production. In that way, EU importers don't have to pay the carbon emission tax. Through CBAM, the EU is aiming to level the price difference for carbon emissions in EU and other countries. And the Union is trying to nudge the non-EU countries into decreasing their carbon emission. However, this tax will increase the costs on poor countries who are exporting to the EU as they have to pay for the new taxes. Brazil, South Africa, India, and China have stressed that carbon border taxes could promote market distortion and worsen the trust deficit among countries.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
One criticism against the carbon border tax is that it will promote green protectionism, which is the practice of unfairly protecting domestic industries against international competition. That's all for today. For more news and analysis, please log into our website www.business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.